Hello and welcome to the second in this series of Lammore's webcasts. My name's Simon Roskrow and this session is going to be about the fundamentals of finance. Finance is one of those subjects that people get a little bit scared of, especially if they're actually not involved in finance in the first place. What we're going to look at here is why it is so important to understand some of the basics around finance regardless of your role in an organisation. How it can help you get clearer on what that organisation is going to deliver. How it can help you make smarter, better, faster decisions that are going to enhance business performance in the long run. And also how it will help you grow as an individual in the organisation and be able to progress your career successfully. One of the things that often happens when people talk about finance and people talk about numbers is that they actually get a little bit scared of it. People tend to run in fear from the idea of, oh my God, here is a spreadsheet full of numbers, full of detail. I'd rather just not get engaged. Things tend to get passed down to the finance department, who are locked in a dark room somewhere, studying things in a great deal of detail. And after a while, some sort of thing emerges and everybody nods along, pretends that they understand it, pretends that they agree with it, and off they go. Wouldn't it be far better if the people making the business decisions, regardless of your size of organisation, could actually understand the rationale behind those business decisions before they're taken? And maybe look creatively at different options that are available and understand the financial impacts of those different options. In a recent article by Theo Pafitis, he reported that 50% of new businesses fail within the first 1 to 2 years. And we all know this to be true. It's one of those statistics that's been around for an awfully long time. There's another interesting way of looking at it though, not just in terms of overall business failure, but failure within businesses. Paul Nutt has written a really interesting book called Why Decisions Fail. And in this book, there's a very clear 10-word summary of the whole book. And it is that the key finding is startling. Decisions fail half the time. He goes through an awful lot of reasons as to why business decisions fail. However, one of the key underlying elements within this is people's lack of ability to understand with clarity how financial impacts need to be evaluated and how financial decisions need to be made. Regardless of the business sector you operate in, the reality is that money makes the world go round. If you work in the third sector, if you work in the public sector, if you work in the private sector, what you actually do with that money at the end, once it's been produced, once that profit has been generated, is going to be wildly different. That's not what this is about though. This is about how we understand the business decisions that need to be made, how we go about making those so that we can generate enough money, enough cash into the business in order to then be able to do with it whatever we want to do with it at the end. That could be something in the third sector that is a charitable cause. In the public sector, it could be about investment in services. And obviously in the commercial sector, it's about driving profitability for the organisation. That is the output part. What we're interested in here is understanding the input part of it. So in this session, I'm going to take you through 4 areas. I'm going to take you through the 3 key financial statements and explain to you what those mean in very, very simple day-to-day terminology. And I'm also going to take you through one of the most common acronyms that's used in the financial world, and again, in day-to-day, simple, plain terminology, explain what that means. The first session then is going to be about the 3 key financial statements: the balance sheet, the profit and loss account, and the cash flow statement. These are statements that all organisations need to report from a legal point of view. And particularly the profit and loss account is one that people tend to get measured on in organisations, regardless of whether they're in finance or not. The first one to look at is the balance sheet. People look at a balance sheet and there is an awful lot of terminology on there in terms of liabilities and creditors and debtors and assets and so on. Actually, a balance sheet is very simple. The first thing to talk about with a balance sheet is that it is a snapshot in time. Imagine it as a photograph, a statement in 1 second in time that says, how much do you own and how much do you owe? And therefore, what is the difference between those 2 things? The amount that you own, if you look at it in personal terminology, would be the portion of your house that you own, your car that you own, your clothing, your laptop, all of those sort of pieces of equipment, those things that have tangible value that you own. In order to create your own personal balance sheet, you then take off all of the things that you owe. That could be credit card debts, it could be your mortgage, it could be loans from a bank and so on. Once you've got those two numbers, it's a very simple piece of maths to say one minus the other is actually your net asset value. Your value, not as a human being, but from a financial point of view, what is your value? The profit and loss account is rather different because the profit and loss account is over a period of time. What that period of time could be can be radically different. It could be over a year, which is a fairly standard period, but you can also have monthly ones, you could have weekly ones, quarterly ones, it really doesn't matter. But what it looks at is apportioning the money that is used in transactions in a business over the period of time that you're measuring. So if you do a certain piece of work in 1 year, that is recorded in your profit and loss account as income or turnover for that part of the year. If you then have costs associated with that piece of activity, that's recorded for that part of the year and is taken from the revenue that you've generated, the turnover that you've generated, and that gives you a first measure of profit. There is, however, a flaw with a profit and loss statement, and that's why we have the third one, the cash flow statement. The flaw with the profit and loss account is that it takes things based on the activity that you've done. But we all know, and we've probably all experienced the fact that you can do a piece of activity for somebody, send them a bill for it, that then gets recorded as a positive item in your profit and loss account, but you don't get paid for ages. Cash flow is there because cash ultimately is king. And it is very simple. It records the flow of money. When does money actually arrive in your business and when does money leave in your business? It basically smooths out the profit and loss account to take account of the fact people won't pay you as soon as you do the work, and equally, you won't pay people as soon as they do the work either. It actually looks at the real cash coming in and out of the business and looks at that to see how well you're doing and how liquid the organisation is. So those are the three key financial statements. I want to delve into one of them in a little bit more detail now and look at the profit and loss account. One of the many acronyms that is used in a profit and loss account is this one, Ebitda. It's a bit of an American version but tends to have been used across the world these days. Ebitda stands for earnings before interest, tax, depreciation and amortization, and I'm going to take you through each of those areas now. The first one of those is the earnings part. The earnings part is literally recording how much money are we going to be getting into the business. It records the activity that we've done and the invoices that we've sent out. It's our turnover measure, which is a more common piece of terminology for it. What we do though is we take off the ongoing costs of actually doing that piece of work. So that can be what we call the direct costs, the costs that would not be incurred if we hadn't done that piece of work. And it also takes off our overhead costs, things like head offices, things like central functions, that would cost us money regardless of whether individual pieces of work have been done or not. What we don't take off, and that's where the Ebitda comes in, are all of those elements that are actually either more accounting related or they're actually outside of the control of the business. So the bit is not just about the money, it's not just about the revenue, it's about saying there are elements that actually are out of the control of the business. And that is, we take earnings before interest and tax. Because as organisations, we don't control the interest rate, we don't control the tax rate, the government do, the Bank of England do. So we take out the effect of interest rates and we take out the effect of taxation to look at the underlying performance of the business. The final bit that we take out when we're looking at an Ebitda measure are these two magical things called depreciation and amortization. Depreciation is relatively easy to understand. If you take something that is going to be used in the business over a long period of time, it wouldn't really be fair to charge it to the business for one period of time, if it's perhaps going to be there for 10. Imagine buying a vehicle. That vehicle will be worth a certain amount when you first buy it, but to put the whole cost of that vehicle in year one is a bit unfair to year one. We need to smooth it over time because it will take a while for it to rust and disintegrate and turn into something that is not valued. We therefore spread that cost over that period of time. Amortization is also about spreading the cost of things over time, but it's about spreading the cost of things that don't really exist, what we call intangible assets, things that you can't touch and feel. And it's actually a way of making numbers do slightly strange things in some regards. This is where some of the mystique of finance really starts to hit us. Normally, of course, 2 plus 2 would equal 4. But when we look at organisations and the value of organisations, sometimes they equal 5. Sometimes they equal 10. Sometimes we add these numbers together and it could even equal 20. And to give you a real illustration of that, let's look at one of the organisations that is always talked about in these sort of things, and it's also the most valuable organisation in the world, Apple. Apple's current market capitalisation, the market value, if you wanted to go and buy that organisation, back in February this year, was just over $700 billion. But actually, if you take the balance sheet of Apple at that time, and you look at everything that it owns and everything that it owes, its actual net value is a lot less than that. It's just over 120 billion. So what is the difference between those two? It's actually the value of the brand, the goodwill of the organisation. And if anybody came in to buy Apple, they would buy it at, let's say, £700 billion. But they wouldn't have that number of assets to put on their balance sheet. They'd have all of this excess, somewhere in the region of 600 billion. That value needs to be spread over time as well. And instead of calling that depreciation, we call it amortization. That's why we can say that we love Ebitda. It's a great measure of how the underlying performance of a business is changing over time, and it takes out all of the dodgy accounting stuff that goes on. It takes out all of the things outside our control, like interest rates and taxation, and it looks at that underlying performance of the business so you can see how well it's really doing. Thank you for listening to this short session on finance. Please do get in touch if you want to find out more. It is an exciting area. We bring it to life for you, and it will make a difference to the way you make decisions in your business.